Hello and welcome to your ultimate guide for the California property and casualty insurance examination. My goal today is simple: give you everything you need to fully understand the key concepts, master them, and walk into your exam with total confidence. In this video we'll cover risk management, liability coverage, policy exclusions, property loss, commercial packages. With over 100 plus success stories, we have proven our videos will help you pass your exam on the first attempt. And remember, our website offers free exam guides and practice questions to help you ace your exam. You will find the link in the description below, so be sure to check it out and get the resources you need to study smarter, not harder. So let's get started.
Question 1. Employment Practices Liability Insurance covers claims arising from which of the following? Your options are A. Property damage from fire, B. Auto collisions, C. Wrongful termination and harassment, D. Product defects. Which one is it? Pause the video if you need more time. The correct answer is C. Wrongful termination and harassment. C is correct because employment practices liability insurance covers claims for employment-related wrongs such as wrongful termination, discrimination, harassment, and retaliation, which the CGL excludes. It protects the company and its directors, officers, and employees. A is wrong because property damage from fire is a first-party property loss, not an employment practices claim. This coverage addresses wrongs arising from the employment relationship, not physical damage to property. B is wrong because auto collisions are covered by commercial auto insurance, not by an employment policy. Employment practices liability concerns workplace conduct claims, not vehicle accidents on the road. D is wrong because product defects fall under products completed operations in the CGL. Claims by employees about workplace treatment, rather than defective products, or what this coverage protects against. Employment practices liability insurance fills a precise gap left by the standard liability program. It exists because the harms that arise inside the employment relationship are a fundamentally different species from bodily injury and property damage. The covered wrongs are intangible workplace harms. These include wrongful termination, discrimination, failure to promote, sexual harassment, retaliation, and hostile work environment, injuries to dignity and economic standing, not physical ones. Hold the four confusable coverages apart by asking what harm each one answers. General liability covers outsiders injured on premises or by a product. Commercial auto covers vehicle crashes. Workers' compensation covers an employee's physical injury on the job. Only employment practices liability answers for the intangible wrongs woven into the employment relationship. The policy protects the organization along with its directors, officers, and employees who may be personally named in a suit. It is almost always written on a claims-made basis. Defense costs are central to the product. Employment litigation is expensive even when the employer prevails, and those defense dollars erode the available limit. The signal words are wrongful termination, discrimination, harassment, and retaliation. Any claim where a current or former employee sues over how the job ended or how the workplace felt. Match the harm to the policy and the categories stop blurring together. Question 2. A commercial property basic form covers volcanic action, but not the earth movement of a volcanic eruption. Which of the following losses would be covered? Your options are A. Damage from airborne volcanic ash and blast, B. Cracking from ground shifting, C. A lava-triggered landslide of soil, D. Foundation damage from earth tremor. Take a second. Which answer would you pick? The correct answer is A. Damage from airborne volcanic ash and blast. A is correct because volcanic action covers the airborne effects of a volcano, such as ash, blast, and shock waves. The excluded earth movement aspect involves the ground itself shifting, which the basic form does not cover. B is wrong because cracking from the ground shifting is earth movement, the part of a volcanic eruption that is excluded. Volcanic action reaches only the airborne effects, not disturbance of the ground. C is wrong because a landslide of soil is earth movement rather than airborne volcanic action. The basic form covers ash and blast, but movement of the earth itself remains excluded from coverage. D is wrong because foundation damage from an earth tremor falls squarely under the earth movement exclusion. Volcanic action covers airborne particulate and blast, not the seismic motion of the ground. When a volcano erupts, a standard commercial property form doesn't treat the whole event as one covered loss. Instead, it splits the eruption into two separate halves based on the physical mechanism causing each specific damage. The covered half is volcanic action, every effect that travels through the air. Ash collapsing a roof, a blast wave shattering windows, or abrasive grit destroying machinery are all airborne causes, and therefore covered under the basic form. The excluded half is earth movement, cracked foundations, soil slides, and tremors that shift a building off its footings are the ground itself moving, and the earth movement exclusion applies regardless of whether a volcano triggered them. The same eruption can generate a covered claim and an excluded claim on the same property. The form classifies each loss by its physical cause, airborne or ground moving, not by naming the volcano as the trigger. The lasting principle is that property forms follow physical mechanism, not event narrative. Keep that sorting rule in mind. If the cause is airborne, volcanic action covers it. If the ground itself is moving, the earth movement exclusion takes it. Question 3. A homeowner could be held legally responsible when his dog bites a visitor. This possibility is best described as which type of loss exposure? Your options are A. A property loss exposure, B. A speculative exposure, C. A liability loss exposure, D. A morale exposure. Before I reveal it, which one do you think is right? The correct answer is C. A liability loss exposure. C is correct because a liability loss exposure is the possibility of being held legally responsible for bodily injury or property damage to others. A dog bite injuring a visitor creates exactly that kind of third-party exposure. A is wrong because a property loss exposure involves damage to the insured's own property, such as the home or its contents. A claim by an injured visitor concerns harm to someone else entirely. B is wrong because speculative risk involves a chance of gain and is uninsurable. The dog bite situation presents only the possibility of loss, which is the hallmark of pure risk, not a speculative exposure. D is wrong because morale is a type of hazard describing careless attitudes, not a category of loss exposure. The question describes potential legal responsibility to a third party, which is a liability matter. Every insurable situation starts with a loss exposure, a condition that creates the possibility of loss. Insurance organizes these into distinct categories, and knowing which category applies changes everything about how a loss is covered. The four main exposure categories are property, liability, personnel, and net income. Each answers a different kind of threat, so an insurer can build separate coverages and a buyer can spot any gap that remains unprotected. A liability exposure runs through the legal system. The insured's conduct harms a third party. The third party asserts a claim, and a court or settlement forces the insured to pay. The insured's own assets, bank accounts, wages, and property will stand exposed to that judgment. The exam deliberately scrambles these labels. Liability means legal responsibility for harm to others. Property means damage to what the insured owns. Pure risk. only loss or no loss, is insurable, while speculative risk, which carries a chance of gain, is not. Hazards are conditions that raise the probability of loss, not exposure categories at all. The fastest way to classify any exposure is to ask two questions: who gets hurt, and does the law impose the obligation to pay? If the harm lands on someone else and a court can make you cover it, you are looking at a liability loss exposure, full stop. Question 4. Under standard ISO rules, a business generally qualifies for a business owner's policy only if each location has a total floor area under what size? Your options are A. 5,000 square feet, B. 10,000 square feet, C. 20,000 square feet, D. 35,000 square feet. What's your answer? Commit to one before I continue. The correct answer is D. 35,000 square feet. D is correct because standard ISO eligibility limits a business owner's policy to locations with a total floor area of less than 35,000 square feet. Larger operations must instead be written on a commercial package policy. A is wrong because 5,000 square feet is far below the eligibility ceiling. ISO actually allows a floor area approaching 35,000 square feet at each qualifying location. B is wrong because 10,000 square feet badly understates the size limit. The real cutoff sits much higher, and ISO draws the line below 35,000 square feet of total floor area. C is wrong because 20,000 square feet still falls under the actual threshold. Eligibility reaches up to the 35,000 square foot ceiling before a commercial package becomes necessary. The Business Owner's Policy, or BOP, is a pre-packaged contract bundling property and general liability coverage for small and medium businesses. Think of it as the commercial cousin of a homeowner's policy, broad, convenient, and built for predictable risks. Eligibility acts as a gate. Insurers check the class of business, revenue for certain classes, and, most critically, the floor area of each location. The key number examiners test is 35,000 square feet per location. When a business fits the eligibility rules, it stays on the convenient package form. The moment a single location crosses 35,000 square feet, E.D. Mason, weight sheet, or the business exceeds another eligibility ceiling, it migrates to the commercial package policy, where coverages are individually rated and tailored to larger, more complex operations. A store at 28,000 square feet qualifies for the BOP. A warehouse showroom at 40,000 square feet pushes past the limit and moves to a commercial package policy. Crossing the threshold does not leave a business uninsured. It simply graduates the account to the right vehicle. The BOP trades flexibility for convenience, and the eligibility ceilings are the price of that trade. Know the 35,000 square foot floor area rule. And remember that exceeding any eligibility limit moves the account to the commercial package policy, not out of coverage. Question 5. Under the mortgage holder condition of a commercial property policy, the insurer may still pay the mortgage holder even when which of the following is true? Your options are A. The insured's claim is denied for fraud. B. The mortgage has been fully paid off. C. The building was never insured. D. The mortgage holder caused the loss. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is A. The insured's claim is denied for fraud. A is correct because the mortgage holder condition protects the lender's interest. So the insurer pays the mortgage holder up to the debt even when the insured's own claim is denied, such as for the insured's own fraud. B is wrong because once the mortgage is fully paid, the lender has no remaining interest to protect. The condition safeguards an outstanding debt, not a loan that has already been satisfied. C is wrong because the protection depends on a valid policy being in force. If the building were never insured at all, there would be no coverage for anyone, including the lender. D is wrong because a mortgage holder that caused the loss would not be protected. The condition shields an innocent lender, not one that is responsible for bringing about the damage. When a bank finances a commercial building, it needs assurance that its collateral is protected even if the borrower does something wrong. That assurance comes from the mortgage holder condition, also called the mortgagee clause. The clause grants the lender 4 concrete rights independent of the property owner: payment up to the loan balance, its own cancellation notice, the ability to file its own proof of loss, and the obligation to pay any unpaid premium to keep the policy alive. Here is how the money flows when an owner's fraud voids their own claim. The insurer denies the owner but still pays the innocent lender up to the remaining mortgage balance. The insurer then steps into the lender's shoes and pursues the owner through subrogation. The protection has clear limits. It disappears when the mortgage is fully paid. There is no debt left to protect. It cannot draw on a policy that never existed, and it never shields a lender that caused the loss or participated in the owner's wrongdoing. This is exactly what examiners test. An owner's fraud defeats the owner's claim, but not the innocent lender's separate claim. The mortgagee clause creates a standalone protected interest that survives the borrower's misconduct. Question 6. California requires a replacement cost residential policy to include building code upgrade coverage of at least what share of the dwelling limit as additional coverage? Your options are A. 2%, B. 5%, C. 10%, D. 50%. Which would you go with? Lock it in before the reveal. The correct answer is C. 10%. C is correct because under California Insurance Code section 10503, a replacement cost residential policy must include building code upgrade coverage of no less than 10% of the dwelling limit, provided as additional coverage that does not deplete the dwelling limit. A is wrong because 2% falls below the statutory floor for code upgrade coverage. California sets the minimum at 10% of the dwelling limit, not a token amount. B is wrong because 5% is still short of the required level. The law fixes the minimum building code upgrade coverage at 10%, so half that figure does not satisfy it. D is wrong because 50% overstates the mandated minimum. The statute requires at least 10%, and while an insured may buy more, the law does not compel a figure that high. When an older home suffers a covered loss, rebuilding it must meet today's codes, not the standards it was originally built to. That extra cost is what building code upgrade coverage, also called ordinance or law coverage, is designed to pay for. A standard replacement cost policy only pays to restore what existed before the loss. But current building codes often require upgraded wiring, framing, energy system, and safety features, and that gap can add tens of thousands of dollars the homeowner didn't expect. California Insurance Code Section 10,103 requires that any replacement cost residential policy include building code upgrade coverage of at least 10% of the dwelling limit. Critically, this is structured as additional coverage. It stacks on top of the dwelling limit rather than being carved out of it. Two details trip up exam candidates. The minimum share is 10%, and the coverage sits on top of the dwelling limit, not inside it. A homeowner who had to borrow code upgrade dollars from the dwelling limit would be no better off on a total loss. In California, this protection is mandatory, not an optional rider. Question 7. The building and personal property coverage form insures the building, the insured's business personal property, and which third category? Your options are A. The insured's licensed vehicles, B. Money and securities, C. Growing crops. D. Personal property of others. Don't overthink it. Which one feels right? The correct answer is D. Personal property of others. D is correct because the building and personal property form covers the building, the insured's business personal property, and the personal property of others in the insured's care at the described premises. Each category needs a separately stated limit. It is wrong because licensed vehicles are specifically listed as property not covered under the form. They are insured under a commercial auto policy, not the building and personal property coverage form. B is wrong because money and securities are excluded from the form and instead handled under commercial crime coverage. They are not one of the 3 property categories that this form insures. C is wrong because growing crops are not covered property under any commercial property form. Crop exposures are addressed through specialized crop insurance rather than the building and personal property form. The building and personal property coverage form is the standard contract insuring a business's physical assets at a specific location. It organizes everything at that location into 3 distinct insuring categories, each with its own limit. The first category is the building itself, the structure and anything permanently affixed to it. The second is business personal property, meaning contents the insured owns and uses, like stock, furniture, and machinery. The third, and most tested, is personal property of others held in the insured's care, custody, or control at the premises. This third category exists because businesses regularly take custody of other people's property. A repair shop holds customers' equipment, a dry cleaner holds garments, a warehouse stores others' goods. The form covers that entrusted property within stated limits, and any payout is made for the account of the actual owner. Picture a cabinet shop struck by fire. The building limit covers the structure. The business personal property limit covers the shop's own lumber and tools, and the personal property of others coverage responds for the contractor's finished cabinets stored there. One form, 3 buckets, each doing a distinct job. When a commercial property question turns on what a standard form covers beyond the building and the insured's own contents. The third category, personal property of others in the insured's care, is almost always the answer the exam is looking for. Question 8. Under the National Flood Insurance Program, which of the following events would not be considered a flood? Your options are A. Sewer backup into the home, B. Overflow of inland or tidal waters, C. Rapid runoff of surface water, D. Mud flow caused by water. Got a guess? Lock it in. The correct answer is A. Sewer backup into the home. Is correct because sewer backup is not a flood under the program's definition, which requires water from a natural external source overflowing normally dry land. Backup from a drain is a separate, often endorsable exposure. B is wrong because overflow of inland or tidal waters is the classic example of a flood. It falls squarely within the program's definition rather than outside it. C is wrong because unusual and rapid accumulation or runoff of surface water is expressly part of the flood definition. It is covered, not excluded, as a form of flooding. D is wrong because mud flow caused by accumulated water is included within the program's flood definition. It qualifies as a flood, unlike an internal sewer backup, which the definition leaves out. Under the National Flood Insurance Program, the word flood has a precise legal meaning. Not every water loss qualifies. Only events that match the program's specific definition trigger coverage. Understanding that definition is the key to sorting covered losses from excluded ones. The program defines flood as a general and temporary inundation of normally dry land from an external water source. Qualifying events include a river overtopping its banks, surface runoff pooling across the ground, unusual accumulation from rain or snowmelt, and tidal water pushing inland. The common thread is water arriving from outside and spreading over land that is ordinarily dry. The cause and path of the water decide whether the program responds. Water that rises across the ground from a swollen creek and enters the home is a flood. Water that backs up through the building's own sewer lines and floor drains is not. It never overflowed dry land. Wind-driven rain entering through a roof opening is also excluded. Signal words point you toward the right answer. Overflow of inland or tidal waters, surface water rising, and inundation of normally dry land all point toward a covered flood. Sewer backup, drain backup, seepage, and water entering through the roof all point away from flood coverage. These losses are handled separately, often by a homeowner's endorsement. The lasting distinction is source and path. External water overflowing normally dry land is a flood the program covers. Water rising through the building's own drains is sewer backup, a different exposure requiring a separate endorsement. Keep the water's origin in view and the qualifying and non-qualifying losses separate cleanly. Question 9. On a dwelling policy, personal liability and medical payments added through the personal liability supplement are designated by which coverage letters? Your options are A coverages A and B, B coverages E and F, C coverages L and M, D coverages C and D. Which one is it? Pause the video if you need more time. The correct answer is C, coverages L and M. C is correct because the personal liability supplement adds coverage L, personal liability, and coverage M, medical payments to others. These mirror the homeowner's coverages E and F but carry their own letter designations. A is wrong because coverages A and B refer to the dwelling and other structures, which are property coverages. They are not the liability designations added by the supplement. B is wrong because coverages E and F are the liability letters used on the homeowner's policy. The dwelling supplement uses L and M, even though the protection is functionally the same. D is wrong because coverages C and D denote personal property and loss of use. Those are property side coverages, not the liability and medical payments added by the supplement. A dwelling policy is built around property coverage, the structure and contents of a 1 to 4 family residence. By itself, it carries no liability protection at all. Liability must be added separately through the personal liability supplement. When an owner adds the personal liability supplement, it brings in exactly 2 coverages under their own designated letters. Coverage L for personal liability and coverage M for medical payments to others. These letters belong to the liability side, separate from the property letters already in the policy. Coverage L responds when the insured is legally responsible for bodily injury or property damage. It pays damages owed and funds the defense. Coverage M pays reasonable medical expenses for accidental injuries on the premises regardless of fault, settling small claims before they escalate. Think of the dwelling policy as 2 distinct systems under one roof. The property side covers the structure and contents under its own letters. The personal liability supplement plugs into the same policy and adds the liability side. Coverage L and coverage M, kept cleanly apart. The exam trap is mixing up the property letters with the liability letters. Keep it clean. L is personal liability, M is medical payments to others, and both arrive only through the personal liability supplement. Question 10. Which of the following is excluded from personal property coverage under a standard homeowner's policy? Your options are A. Furniture in the living room, B. Clothing kept in closets, C. A guest's property if requested, D. A motor vehicle and its parts. Take a second. Which answer would you pick? The correct answer is D. A motor vehicle and its parts. D is correct because motor vehicles and their equipment are excluded from coverage C, apart from items like a riding mower used to service the premises. Standard personal property coverage is not meant to insure automobiles. A is wrong because household furniture is exactly the kind of personal property coverage C is designed to insure. It is covered, not excluded, up to the coverage C limit. B is wrong because clothing is ordinary personal property covered under coverage C up to its limit. There is no exclusion for an insured's wardrobe or other everyday belongings kept in the home. C is wrong because a guest property can be covered at the insured's request while on the resident's premises. Rather than being excluded, it may be brought within coverage C. Coverage C of a homeowner's policy protects personal property, but not everything a family owns qualifies. Certain categories are carved out by design, and motor vehicles top that list. The exclusion exists because automobiles carry their own distinct exposures: collision, theft, and liability from driving. Auto policies are priced and rated for exactly those risks. If a homeowner's policy also paid for the car, premiums would not match the risk and claims would tangle between two contracts. Picture a garage break-in where golf clubs and power tools are stolen alongside a spare automobile engine. The clubs and tools are ordinary personal property. Coverage C responds. The engine, being a motor vehicle part, is excluded. The homeowner's policy draws a clean line, and the auto policy owns that exposure. The exclusion names motor vehicles and their parts as property coverage C will not touch. One narrow exception applies: unregistered vehicles used to service the residence, like a riding lawnmower, can qualify as personal property. A registered car on the street is squarely excluded, no exceptions. Keep that division in mind every time you see a list mixing household belongings with a vehicle or its parts. Coverage C protects what belongs inside the home policy and pushes everything else to the policy built to handle it. Question 11. A boat owner's policy designed for smaller pleasure boats is written on which kind of marine form? Your options are A. An inland marine form, B. An ocean marine form, C. A commercial liability form, D. A workers' compensation form. Before I reveal it, which one do you think is right? The correct answer is A. An inland marine form. A is correct because a boat owner's policy for smaller pleasure boats is written on an inland marine form and settles property losses at actual cash value. It typically covers the boat, motor and trailer on an open peril basis. B is wrong because the ocean marine form is used for larger yachts, generally 26 feet or longer. Smaller pleasure boats are written on the inland marine boat owner's form rather than ocean marine. C is wrong because a commercial liability form covers a business's liability to others, not a personal pleasure boat. The boat owner's policy is an inland marine package for personal watercraft and its owner. D is wrong because a workers' compensation form covers employee injuries, which has nothing to do with insuring a pleasure boat. A pleasure boat belongs on an inland marine policy, not on a coverage form for workplace injuries. Marine insurance divides into two distinct branches, ocean marine and inland marine. Understanding which branch covers which vessel is the key classification skill examiners test. Ocean marine covers large commercial vessels, yachts, and the cargo they carry across seas. Inland marine grew from the need to cover movable property away from a fixed location, and the small boat market settled naturally onto inland marine forms. A boat owner's policy bundles physical damage coverage on the hull, motor, and trailer with liability protection for injuries or damage caused to others. Crucially, coverage follows the boat, on the lake, on the trailer, or in winter storage, reflecting the inland marine principle that protection travels with movable property. The classification turns on size and use. Small recreational boats belong on inland marine boat owners' forms. Large yachts and commercial ships belong on ocean marine policies with formal hull and protection and indemnity sections. Never assume that anything that floats is automatically ocean marine. Question 12. Which of the following dwellings is generally not eligible for a standard homeowner's policy? Your options are A. An owner-occupied single-family home, B. A working farm dwelling, C. An owner-occupied two-family home, D. A condominium unit. What's your answer? Commit to one before I continue. The correct answer is B. A working farm dwelling. B is correct because a farm dwelling is generally not eligible for a standard homeowner's policy and is instead covered under a farm owners or specialty program. Homeowners forms target owner-occupied residences of 1 to 4 families. A is wrong because an owner-occupied single-family home is the core eligible risk for a homeowner's policy. It is exactly the kind of residence the forms are designed to insure. C is wrong because owner-occupied dwellings of up to 4 families qualify for homeowners coverage. A two-family home occupied by its owner fits squarely within eligibility rather than outside it. D is wrong because a condominium unit is eligible, insured under the HO6 unit owners form. Condo ownership is specifically accommodated by its own dedicated form rather than being excluded from coverage. Not every dwelling qualifies for a standard homeowner's policy. The key is whether the property carries residential exposures or agricultural ones, because those two risk profiles demand 2 different forms. A homeowner's policy is built around residential hazards, a family, their belongings, and ordinary personal liability. Its premiums are calculated for that exposure only. So folding an agricultural risk would load the policy with costs it never priced for. A working farm introduces exposures the homeowner's form neither contemplates nor prices for: barns, livestock, equipment, and agricultural liability. Once those elements are present as a commercial operation, the property no longer fits the homeowner's mold. The market answers the farm exposure with its own product, the farm owner's policy. It blends residential coverage on the farmhouse with commercial coverage on the farm structures, equipment, livestock, and farming liability, keeping each contract matched to the risk it was rated for. The signal words to watch for are working farm, ranch, livestock, and income-producing agriculture. When those appear, the homeowner's form steps aside and the farm owner's form takes over. Question 13. Under a liability policy, the insurer's duty to defend the insured is generally described how compared with its duty to pay damages. Your options are A. Narrower than the duty to pay, B. Identical to the duty to pay, C. Or broader than the duty to pay, D. Owe it only after a verdict. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Broader than the duty to pay. C is correct because the duty to defend is broader than the duty to indemnify, arising whenever a claim potentially falls within coverage, even if it proves groundless or false. California courts interpret this duty to defend especially broadly. A is wrong because the duty to defend is wider, not narrower, than the duty to pay. The insurer must defend any claim that might be covered, even if it ultimately owes no damages at all. B is wrong because the two duties are not identical in scope. The duty to defend sweeps more broadly over potentially covered claims, while the duty to indemnify applies only to covered damages actually owed. D is wrong because the defense duty begins when a suit is brought, not after a verdict. Waiting until a judgment would defeat the purpose of providing the insured a defense in the first place. Liability insurers actually make 2 separate promises when they issue a policy: a duty to defend the insured in litigation, and a duty to indemnify, that is, to pay damages the insured is legally obligated to pay. These are distinct obligations and they are not the same size. Think of it as two circles. The duty to defend is the larger outer circle. The duty to indemnify sits inside it as the smaller circle. Every claim the insurer must pay falls within the defense circle, but not every defended claim results in a payment. The defense duty is broader by design. It is triggered by allegations alone. If the claim could potentially fall within the policy, the insurer must defend, even if some allegations are outside coverage and even if the suit turns out to be completely groundless. The duty to indemnify is the narrower promise. It attaches only when the insured is actually found legally obligated to pay damages for a covered loss. Notably, defense costs are provided in addition to the policy limit, underscoring that defending and paying are entirely separate obligations. The key insight is that an insurer may have to defend a claim it never ends up paying, but it will never pay a claim without that broader defense obligation having existed first. Defend is the larger circle, indemnify is the smaller one inside it. Question 14. California's Fair Employment and Housing Act applies to employers with at least how many employees for most provisions? Your options are A. 20 employees, B. 50 employees, C. 100 employees, D. 5 employees. Which would you go with? Lock it in before the reveal. The correct answer is D. 5 employees. D is correct because California's Fair Employment and Housing Act applies to employers with 5 or more employees for most provisions, a lower threshold than the federal 15-employee standard. It is enforced by the California Civil Rights Department. A is wrong because 20 employees is not the California threshold. The Fair Employment and Housing Act reaches employers with as few as 5 employees, a broader scope than many federal protections. B is wrong because 50 employees is associated with certain leave laws, not the General Fair Employment and Housing Act threshold. California applies most of its provisions at 5 or more employees. C is wrong because 100 employees far overstates the threshold. California's Fair Employment and Housing Act covers employers with 5 or more employees, capturing many small businesses. The California Fair Employment and Housing Act is the state's primary civil rights law covering workplace discrimination, harassment, and retaliation. One of its most important features is how far down it reaches in terms of employer size. FEHA's core discrimination provisions apply to employers with 5 or more employees, compared to the federal threshold of 15. Critically, FEHR's harassment protections extend even further, reaching employers with as few as 1 employee. This means the federal law leaves smaller firms uncovered where California law does not. Consider a small studio with 6 employees where a worker alleges disability discrimination. Because the employer meets the 5-employee threshold, FEHA applies and the worker can pursue a state claim, even though the business is too small for federal law to cover. The key distinction is simple. California deliberately set a lower bar than federal law to protect more workers. Fix on 5 employees for most FEHA provisions, 1 employee for harassment, and 15 for the federal statute, and you will place the threshold correctly every time. Question 15. Under the CGL, a newly acquired or formed organization is treated how? Your options are A. Newly formed organizations get 90 days. B. They are never covered. C. They are covered for 1 year. D. They require a new policy immediately. Don't overthink it. Which one feels right? The correct answer is A. Newly formed organizations get 90 days. A is correct because under the CGL, a newly acquired or formed organization is automatically covered as an insured for up to 90 days or the end of the policy period, whichever comes first. This gives the insured time to arrange permanent coverage. B is wrong because newly formed organizations do receive automatic coverage for a limited time. Saying they are never covered ignores the 90-day automatic extension the CGL provides. C is wrong because the automatic coverage lasts up to 90 days, not a full year. A 1-year automatic extension overstates the limited window the CGL grants for newly formed organizations. D is wrong because the insured is not required to obtain a new policy immediately. The CGL extends automatic coverage for up to 90 days. That window allows time to arrange permanent coverage. When a business acquires or forms a new organization mid-policy, the commercial general liability policy automatically extends insured status to that new entity. This temporary protection exists so there is no dangerous gap in coverage the moment a subsidiary is acquired. Coverage begins automatically on the date of acquisition or formation, runs for 90 days or until the policy period ends, whichever comes first. After that window closes, the named insured must report the change and have the organization endorsed onto the policy to maintain protection. The automatic status has strict boundaries. It does not apply to partnerships, joint ventures, or limited liability companies not already named as insureds, and it never reaches back to cover bodily injury or property damage that occurred before the organization was acquired or formed. Visually, the 90-day window is a short corridor inside the policy period. If the named insured notifies the insurer and secures an endorsement before the window closes, coverage continues seamlessly. If not, the new organization simply falls off the policy when the 90 days expire. The key distinction is that new organization coverage is temporary and forward-looking only. It buys breathing room to report the acquisition. It is never a permanent substitute for a proper endorsement. Question 16. Under a personal auto policy, an insured who buys an additional vehicle must usually report it to the insurer within how many days to continue coverage? Your options are A. 4 days, B. 14 days, C. 30 days, D. 60 days. Got a guess? Lock it in. The correct answer is B. 14 days. B is correct because a newly acquired additional vehicle is automatically covered, but the insured generally must report it within 14 days to continue that coverage. The new auto receives the broadest coverage already on the policy. A is wrong because 4 days is the separate window to request physical damage coverage when none is on the policy, not the general reporting period. Reporting a newly acquired auto allows 14 days. C is wrong because 30 days overstates the reporting window for a newly acquired auto. The insured must notify the insurer within 14 days to keep the automatic coverage in force on the new car. D is wrong because 60 days far exceeds the reporting requirement. A newly acquired vehicle must be reported within 14 days, not 2 months, to continue its coverage under the policy. When you add a new car to your household during a policy term, your personal auto policy handles it in one of 2 ways, and the rules are very different depending on which situation applies. A replacement vehicle steps into the shoes of the car it replaces, so coverage continues more automatically. An additional vehicle is a net new car in the household fleet. The policy grants temporary automatic coverage, but the insured must report it to the insurer within 14 days to keep that coverage firmly in force. Think of a replacement vehicle like a substitute player. The roster size doesn't change, so the league barely notices. An additional vehicle is a brand new roster spot. The league needs to know about it and update its records. Here you can see the contrast in practice. A replacement vehicle slots directly into the prior car's coverage. An additional vehicle expands the fleet, so the insurer needs notice, typically within 14 days, to rate and endorse the new car. Sort the new car into the right category and the obligation becomes clear. Replace a car and coverage follows automatically. Add a car and the clock starts ticking. Report it within 14 days or risk losing that broad automatic protection. Question 17. An insurance company transfers part of the risk on its policies to another insurer in exchange for a premium. This arrangement is known as which of the following? Your options are A. Coinsurance, B. Subrogation, C. Reinsurance, D. Self-insurance. Which one is it? Pause the video if you need more time. The correct answer is C. Reinsurance. C is correct because reinsurance is insurance for insurers. The ceding company transfers part of its risk to a reinsurer for a premium. It protects the cedant from catastrophic or oversized losses and stabilizes underwriting results. A is wrong because coinsurance is a property policy provision requiring the insured to carry a stated percentage of value. It governs how a claim is settled, not the transfer of risk between two insurers. B is wrong because subrogation is the insurer's right to recover a paid claim from the party at fault. It involves a third party who caused a loss, not a risk-sharing deal with another insurer. D is wrong because self-insurance is a business retaining and funding its own risk. Reinsurance instead involves one insurer ceding risk to another, so the two arrangements are clearly not the same. Reinsurance is the mechanism by which one insurance company transfers part of its own risk to another insurer. The company passing the risk is called the ceding company, and the company accepting it is the reinsurer. The original policyholder never interacts with the reinsurer directly. The arrangement operates entirely behind the scenes. The primary insurer remains fully responsible to its policyholder, but offloads a portion of its exposure to the reinsurer in exchange for a premium. This keeps a single catastrophic loss, like a devastating wildfire season, from exhausting the primary insurer's capital. Reinsurance serves four key purposes for the ceding company. It caps potential losses, stabilizes results from year to year, frees up capacity to write more business, and provides protection against rare but enormous catastrophes. Reinsurance is arranged in two ways. Treaty reinsurance automatically covers an entire class of the ceding company's policies under agreed terms. Facultative reinsurance is negotiated one risk at a time, used when the insurer wants to lay off a single large or unusual exposure. The key distinction is who transfers risk to whom. Reinsurance moves risk from one insurer to another insurer. Coinsurance involves the policyholder sharing a property loss with their own insurer. Retention means the insurer keeps the risk entirely. When the transfer runs insurer to insurer for a premium, that arrangement is reinsurance. Question 18. A personal umbrella policy differs from a pure excess liability policy primarily because the umbrella can do which of the following? Your options are A. Only add higher limits, B. Pay first-party medical bills, C. Replace the underlying policy entirely, D. Drop down to cover some excluded losses. Take a second. Which answer would you pick? The correct answer is D. Drop down to cover some excluded losses. D is correct because an umbrella can drop down to provide primary coverage for certain losses the underlying policies exclude, subject to a self-insured retention. A pure excess policy only adds limits to the same coverage and adds no new protection. A is wrong because merely adding higher limits describes a pure excess policy. An umbrella does more, dropping down to cover some losses the underlying policies exclude, which is its distinguishing feature. B is wrong because paying first-party medical bills is not the umbrella's function. An umbrella provides excess and drop-down liability coverage, not the insured's own medical payments after an accident. C is wrong because an umbrella sits above the underlying policies rather than replacing them. It requires those underlying policies to be maintained and supplements them instead of taking their place entirely. Both personal umbrella policies and pure excess policies sit above your underlying home and auto coverage, adding a high layer of protection, but they work very differently, and understanding that difference is essential. A pure excess policy simply extends the limits below it. It pays after the underlying limits are exhausted, but only for losses the underlying policy would already cover. A personal umbrella does that too, but it also does something the pure excess form cannot. It drops down to cover certain losses the underlying policies exclude entirely. When a claim exceeds the underlying limit, the umbrella pays the excess on top, just like a pure excess policy. But when a claim falls into a gap that the underlying policy excludes, the umbrella drops down and pays after the insured satisfies the self-insured retention. That retention is the umbrella's version of a deductible for the gaps it alone covers. The umbrella's three defining features are paying excess above underlying limits, dropping down to cover certain excluded losses, and requiring a self-insured retention when no underlying policy applies. The drop-down ability is the single marker that separates a personal umbrella from a pure excess form. Remember, a pure excess policy is just height. It mirrors the underlying terms and adds limits. A personal umbrella is both taller and broader, able to respond where the underlying policies cannot. Breadth versus mere height is the distinction examiner's test. Question 19. Purchasing an insurance policy is the most common example of which risk management technique? Your options are transfer, B. avoidance, C. retention, D. loss control. Before I reveal it, which one do you think is right? The correct answer is A. Transfer. A is correct because buying insurance transfers the financial consequences of a risk from the insured to the insurer in exchange for a premium. Transfer is the technique at the heart of every insurance transaction. B is wrong because avoidance eliminates the exposure by abandoning the risky activity. Someone who buys insurance still keeps the activity and the risk, choosing to shift the cost rather than walk away. C is wrong because retention means keeping a risk and paying for losses personally. Purchasing a policy does the reverse by handing the financial burden to an insurer instead of bearing it alone. D is wrong because loss control reduces how often or how badly losses occur, such as installing sprinklers. It works alongside insurance but is not the act of shifting risk that buying a policy represents. Risk management offers several techniques for handling loss exposures. Understanding how they differ and how insurance fits among them is the core skill examiner's test. There are 4 techniques. Avoidance eliminates the activity entirely. Reduction uses safety measures to shrink the risk. Retention means absorbing losses yourself, and transfer moves the financial burden onto someone else, which is exactly what buying insurance does. In practice, transfer works by contract. The insured pays a premium and the insurer promises to cover losses up to policy limits. The insurer can absorb that transferred risk because it pulls premiums from many policy holders to fund the losses of the few. Examiners embed clues in the language. Transfer signals include buying a policy, paying a premium, or a hold harmless agreement. Avoidance language describes not doing the activity. Reduction references safety measures. Retention describes paying losses personally. The distinction to hold is simple. Avoidance refuses the risk. Reduction shrinks it. Retention keeps it. And transfer moves it. Whenever the action is purchasing a policy, the technique is transfer, every time. Question 20. Under California law, what must an insurer do regarding earthquake coverage when it issues a residential property policy? Your options are: A. Include it automatically in every policy. B. Offer earthquake coverage to the applicant. C. Refer the applicant to the FAIR plan. D. Exclude it without any notice. What's your answer? Commit to one before I continue. The correct answer is B. Offer earthquake coverage to the applicant. B is correct because California Insurance Code Section 181 requires insurers to offer earthquake coverage to every residential property applicant. The duty is to make the offer. The applicant may then accept or decline it. A is wrong because the law requires an offer, not automatic inclusion. Standard residential policies still exclude earthquake unless the applicant accepts the coverage that must be offered. C is wrong because the earthquake obligation is satisfied by offering coverage, often through the California Earthquake Authority or a private insurer, not by routing the applicant to the FAIR plan, which does not write earthquake. D is wrong because an insurer cannot simply exclude earthquake silently without telling the applicant. The statute affirmatively requires that the coverage be offered to every residential applicant before issuance. California law imposes a specific obligation on residential property insurers regarding earthquake coverage. Understanding the precise nature of that duty is essential because it is a duty to offer, not a duty to provide. Under California Insurance Code Section 181, every insurer writing residential property insurance must present an earthquake coverage offer to each applicant. The applicant freely accepts or declines. The standard homeowners policy continues to exclude earthquake damage regardless. The offer simply guarantees the homeowner a conscious choice. The standard homeowners policy simply excludes the quake peril. The insurer must put a separate earthquake offer in front of the applicant, often fulfilled through the California Earthquake Authority, a state-established pool. If the applicant accepts, a separate policy or endorsement covers shake damage. If they decline, the gap remains. The trap in exam questions is confusing offering with providing. The insurer is not required to include earthquake coverage in the base policy or pay quake claims under the standard form. The duty is fulfilled the moment the offer is made. The applicant's decision determines whether protection exists. California mandates the offer, so homeowners never unknowingly fall into an unprotected position. The insurer offers, the applicant decides, and earthquake stays separate from the standard policy. That distinction is exactly what the exam tests. Question 21. Under a commercial property policy, fixtures a tenant installs and cannot legally remove are insured as which of the following? Your options are A. The landlord's building coverage, B. Personal property of others, C. Improvements and betterments, D. Money and securities. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Improvements and betterments. C is correct because tenant installed fixtures that cannot be legally removed are improvements and betterments, insured as part of the tenant's business personal property and valued at actual cash value under the commercial property form. A is wrong because the landlord's building coverage insures the structure the landlord owns, not the tenant's installed fixtures. Those permanent alterations are instead the tenant's own improvements and betterments. B is wrong because personal property of others covers property left in the insured's care, not the tenant's own permanent alterations. Irremovable fixtures the tenant added are improvements and betterments. D is wrong because money and securities form a separate, excluded category handled under crime coverage. Permanent fixtures that the tenant installed are classified as improvements and betterments instead. When a tenant permanently alters leased space, that investment creates a unique insurance challenge. The items belong legally to the building, yet the tenant paid for them. So who insures them and how? An improvement and betterment is any permanent addition a tenant installs that merges into the realty. The defining test has two parts. The item is affixed to the structure and the tenant has no legal right to remove it when the lease ends. This three-way split resolves the ownership puzzle. The landlord covers the building. The tenant covers removable property as business personal property. Permanent. Non-removable additions fall into the gap between those two, and improvements and betterments coverage fills it. Picture a restaurateur in a leased storefront. The built-in hood system and bolted booth seating cannot leave. Those are improvements and betterments. Movable equipment the tenant can carry out is business personal property. The walls and structure belong to the landlord's building policy. Whenever you see tenants installed, permanently attached, and legally non-removable, that's improvements and betterments. It protects the money a tenant sinks into property that someone else owns. Question 22. Which of the following is excluded under the basic, broad, and special commercial causes of loss forms alike? Your options are A. Fire, B. Windstorm, C. Vandalism, D. Flood and earth movement. Which would you go with? Lock it in before the reveal. The correct answer is D. Flood and earth movement. D is correct because flood and earth movement are excluded under all three commercial causes of loss forms. Flood requires separate coverage, while earth movement can be restored through an earthquake endorsement for added premium. A is wrong because fire is the foundational covered peril in every causes of loss form. It anchors the basic form rather than being excluded from commercial property coverage. B is wrong because windstorm is a named covered peril in the basic form and the broader forms. It is insured, not excluded, across all three commercial property causes of loss forms. C is wrong because vandalism is among the named perils covered by the basic form. It is a covered cause of loss, unlike flood and earth movement, which all three forms exclude. Commercial property insurance comes in three causes of loss forms, each covering a wider range of perils than the last. Understanding how they relate, and what limits all three, is essential for anyone working with commercial property coverage. The basic form names a short list of covered perils. The broad form adds several more. The special form flips the logic entirely, covering any direct physical loss unless specifically excluded. This is called open peril coverage. Despite their differences, all three forms share a core set of exclusions. Flood and earth movement sit squarely among them, excluded under the basic form, the broad form, and even the special open peril form. These two perils are excluded because they are catastrophic, geographically concentrated, and capable of producing enormous simultaneous losses. Standard commercial property pricing simply cannot absorb events that strike many properties at once in a single occurrence. The key takeaway is that moving from basic to broad to special adds covered perils but never erases the shared exclusions. A business that wants flood or earthquake protection must arrange it separately, outside the standard causes of loss forms entirely. Question 23. Which of the following correctly describes a self-insured retention on a commercial umbrella policy? Your options are A. Under NFIP, the insured pays first. B. The insurer pays the SIR first. C. And SIR raises the policy limit. D. And SIR equals a premium. Don't overthink it. Which one feels right? The correct answer is A. Under NFIP, the insured pays first. A is correct because under a self-insured retention, the insured pays the loss first up to the retention amount, and the insurer's obligation begins only after that. With a deductible, the insurer pays the full loss first and then seeks reimbursement. B is wrong because under a self-insured retention, the insured, not the insurer, pays first. The insurer responds only after the retention is satisfied, which is what distinguishes it from a deductible. C is wrong because a self-insured retention does not increase the policy limit. It is the amount the insured retains before the umbrella responds, not in addition to the available coverage. D is wrong because a self-insured retention is a retained loss amount, not a premium. The premium is the charge for the policy, while the retention is what the insured pays on a covered loss first. When a commercial umbrella covers a loss that no underlying policy reaches, there is no primary insurer to absorb the first dollars. That gap is handled through a self-insured retention, which requires the insured itself to pay from the very first dollar before the umbrella responds. Think of coverage as stacked layers. At the bottom sits the self-insured retention, the insured's own financial layer. Above it is the gap exposure no underlying policy covers. Only after the insured exhausts the retention does the umbrella step in above. The self-insured retention serves three purposes. It keeps the insured financially engaged in gap losses, discourages small or frivolous claims, and allows the umbrella to be priced for catastrophic exposure rather than routine ones. The critical distinction is who fronts the money. Under a self-insured retention, the insured pays from the first dollar and manages the claim within that layer. Under a deductible, the insurer pays the full loss up front and then seeks reimbursement from the insured afterward. Whenever you see language stating the insured pays first, up to a retention amount, on losses no underlying policy covers, that signals a self-insured retention, not a deductible. Lock on to who fronts the money and you will always identify the SIR correctly. Question 24. Which of the following parties clearly has an insurable interest in a financed automobile? Your options are A. A neighbor who admires the car. B. The bank that financed the car. C. A passing pedestrian. D. A former owner who sold it. Got a guess? Lock it in. The correct answer is B. The bank that financed the car. B is correct because a lender that financed the vehicle holds a security interest and would suffer a financial loss if the car were destroyed. That genuine stake gives the bank a clear, insurable interest in the auto. A is wrong because admiration is not a financial stake. The neighbor loses nothing if the car is wrecked. Insurable interest requires the possibility of direct financial harm, which mere interest cannot create. C is wrong because a pedestrian has no ownership, lien, or other financial connection to the vehicle. Without exposure to monetary loss from damage to the car, there is no insurable interest. D is wrong because once the car is sold, the former owner no longer stands to lose if it is damaged. Insurable interest follows the financial stake which transferred to the buyer at the sale. Insurable interest is the legal requirement that a person seeking insurance must stand to suffer a real financial loss if the insured property is damaged or destroyed. Without this stake, a policy would be a wager, not a contract of indemnity. Insurable interest typically arises from three sources: ownership, a secured creditor relationship like a bank lien, or another legal or financial connection that means destruction of the property directly hurts the holder economically. Consider a finance car. The driver holds insurable interest because they own the vehicle and would lose equity and transportation. The lending bank holds insurable interest up to the outstanding loan balance because the car is its collateral. A neighbor who simply admires the car has no financial stake and therefore no insurable interest at all. The insurable interest requirement serves three purposes. It prevents insurance from becoming gambling. It reduces moral hazard by removing any incentive to destroy property one has no reason to preserve. And it ensures that a claim only indemnifies someone who suffered a genuine financial setback. The key question is always, who actually loses money if this property is destroyed? On a finance vehicle, that is the owner and the lender. Any party with no ownership and no secured claim fails the insurable interest test, no matter how close they are to the property. Question 25. In an ISO commercial policy, the words you and your refer to which party? Your options are A, the insurer, B, the claimant, C, the named insured, D, the state regulator. Which one is it? Pause the video if you need more time. The correct answer is C, the named insured. C is correct because in ISO commercial forms, you and your refer to the named insured, while we, us, and our refer to the insurer. This consistent usage runs through all of the standard commercial coverage forms. A is wrong because the insurer is referenced by the words we, us, and our, not you. Reversing the pronouns would misread every insuring agreement throughout the commercial coverage forms. B is wrong because a third-party claimant is not a party to the contract and is never addressed as you. The policy reserves the word you for the named insured who holds the coverage. D is wrong because the state regulator has no role as a party to the policy at all. The pronoun you consistently identifies the named insured throughout each commercial coverage form. ISO commercial policies use a small set of defined pronouns to identify the two main parties throughout the contract. Understanding these definitions is essential to reading any ISO form correctly. The named insured, the party buying coverage, is always referred to as you and your. The insurer, the company providing coverage, is always we, us, and our. These definitions appear early in the policy and never change. These pronouns are not conversational, ma'am. They are technical defined terms. A third-party claimant is never called you because a claimant is not a party to the contract. Only the named insured and the insurer hold these labels. When a condition says you must report a loss, the duty falls on the named insured. When the insuring agreement says we will pay, the promise belongs to the insurer. The pronouns lock down exactly which party owes each obligation. The classic exam trap reverses these pairs, assigning you to the insurer or attaching either pronoun to an outside claimant. Keep the two pairs anchored to their correct roles, and the policy reads exactly as its drafters intended. Question 26. Part A of the personal auto policy provides which of the following coverages? Your options are A, damage to the insured's own car, B, the insured's own medical bills, C, rental reimbursement, D, liability for injury or damage to others. Take a second, which answer would you pick? The correct answer is D, liability for injury or damage to others. D is correct because Part A is the liability coverage, paying for bodily injury and property damage the insured is legally responsible for, and it also provides a defense. Damage to the insured's own car falls instead under Part D. This is wrong because damage to the insured's own vehicle is covered under Part D physical damage, not Part A. Part A responds to the insured's liability for harm caused to other people and their property. B is wrong because the insured's own medical bills fall under Part B medical payments. Part A is third-party liability coverage, paying others the insured injures rather than the insured's own treatment. C is wrong because rental reimbursement is a transportation expense feature tied to physical damage coverage rather than to liability. Part A instead covers the insured's legal responsibility for injury and damage to others. Part A of the personal auto policy is the liability coverage, the foundation the law most insists upon. It responds when the insured is at fault and pays for harm caused to other people and their property. Part A pays bodily injury damages to other people, property damage to others' vehicles or property, and provides a legal defense against covered claims, all on the insured's behalf, up to the policy limits. The personal auto policy divides into 4 lettered parts. Part A is liability for injury or damage to others. Part B covers medical payments regardless of fault. Part C handles uninsured motorist. Part D covers damage to the insured's own vehicle. Think of Part A as facing outward. When the insured causes a crash, Part A stands behind them and delivers funds to the injured pedestrian and the owner of the damaged car, covering bodily injury and property damage to third parties. The key distinction is direction. Part A faces outward, paying others for harm the insured caused. Parts B, C, and D face inward, protecting the insured, the occupants, and their own vehicle. Whenever the harm falls on other people, the coverage is Part A. Question 27. Under a California personal auto policy, a person who drives the insured's covered auto with permission is generally treated how? Your options are A. As an insured for that use, B. As an excluded driver, C. As a third-party claimant, D. As a named insured permanently. Before I reveal it, which one do you think is right? The correct answer is A. As an insured for that use. A is correct because California requires permissive use coverage. So a person driving the insured's covered auto with express or implied permission is generally an insured for that use. Courts construe this permissive use requirement broadly in favor of coverage. B is wrong because a permitted driver is covered, not excluded. A driver becomes excluded only through a specific written driver exclusion agreement, not simply by borrowing the car with the owner's permission. C is wrong because a permitted drive of the covered auto is an insured, not a third-party claimant. The third party is the person harmed, while the permitted driver enjoys the policy's protection. D is wrong because driving with permission does not make someone the permanent named insured. The permitted driver is an insured for that particular use, not a lasting substitute for the policyholder. When an owner allows someone else to drive their covered auto, that permission does more than hand over the keys. It extends the policy's protection to the driver for that use. The permissive use rule has 4 key points. A permitted driver is treated as an insured for that use. Liability coverage follows the car. A driver without permission gets no extension of coverage, and a driver the policy specifically excludes is never protected. Visually, think of coverage flowing from the owner through the vehicle to the permitted driver. The car is the conduit. As long as consent exists, the policy's liability protection rides along with whoever is behind the wheel. 3 reasons drive this rule. Cars are routinely lent to friends and family. The public has an interest in ensuring injured parties can recover, and consent is the single hinge that determines whether coverage extends to the driver. The bottom line, when the owner's consent stands behind the trip, the permitted driver steps into the policy's protection. Remove that consent or find an exclusion, and the coverage does not follow. Question 28. Under California's AB5 and the ABC test, how is a worker's status determined? Your options are A. Presumed an independent contractor, B. Presumed an employee unless 3 conditions met, C. All workers are independent contractors, D. The test applies only to large employers. What's your answer? Commit to one before I continue. The correct answer is B. Presumed an employee unless 3 conditions met. B is correct because under California's AB5 and the ABC test, a worker is presumed an employee unless the hiring entity proves the worker is free from control, performs work outside the usual business, and is independently established in that trade. A is wrong because the ABC test presumes a worker is an employee, not an independent contractor. The hiring entity bears the burden of proving all 3 conditions to classify the worker otherwise. C is wrong because the test does not treat all workers as independent contractors. It does the opposite. Workers are presumed employees unless every prong of the ABC test is satisfied by the hiring entity. D is wrong because the ABC test is not limited to large employers. It applies broadly to determine worker classification regardless of the employer's size. with only specific occupational exemptions. California's ABC test, created by Assembly Bill 5, governs whether a worker is an employee or an independent contractor. The test starts with a presumption. Every worker is an employee unless the hiring entity can prove otherwise. To overcome the employee presumption, the hiring entity must satisfy all three prongs. Condition A requires the worker be free from the company's control. Condition B requires the work fall outside the company's usual business. Condition C requires the worker operate an independently established trade or occupation. Failing even one prong means the worker is an employee. Visually, every worker starts as a presumed employee. The hiring entity must prove all three conditions, A, B, and C, to move that worker to independent contractor status. One failed condition is enough to keep the employee classification intact, along with all protections like workers' compensation. Think of the ABC test like a three-legged stool. Remove even one leg and the whole thing falls. The hiring entity cannot pick and choose. All three conditions must hold, or the worker remains an employee by default. The key insight is direction and completeness. California presumes employee status, and the burden rests entirely on the business to prove all three ABC conditions. Missing any single one defeats contractor classification. Question 29. The broad causes of loss form covers everything in the basic form, plus additional perils, including which of the following? Your options are A. Flood, B. Earthquake, C. Collapse and falling objects, D. Wear and tear. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Collapse and falling objects. C is correct because the broad form adds perils beyond the basic list, including collapse, falling objects, weight of ice and snow, and accidental water discharge. It sits between the basic and special forms in overall breadth. A is wrong because flood is excluded even under the broad form. Adding flood protection requires separate coverage through a flood program, not the broad causes of loss form. B is wrong because earthquake is not added by the broad form, since earth movement stays excluded. Earthquake coverage requires a separate endorsement rather than coming with the broad form. D is wrong because wear and tear is never a covered peril. It is excluded as gradual deterioration. The broad form adds fortuitous perils like collapse, not ordinary maintenance-related losses. Commercial property insurance offers 3 tiers of causes of loss coverage. The broad form sits in the middle, still a named peril form, but with a longer list than the basic form provides. The basic form covers core perils like fire, windstorm, and vandalism. The broad form adds falling objects, weight of ice, snow, or sleet, water damage from plumbing leakage, and collapse as an additional coverage, perils the basic form simply does not name. Falling objects are covered only when the object first breaches the exterior. Interior damage alone does not trigger coverage, and the object itself is not covered. Collapse applies only when triggered by specified causes, such as hidden decay or the weight of contents, not just any cause whatsoever. Picture a 3-rung ladder. The basic form names a short core list. The broad form adds falling objects, weight of ice, snow, or sleet, water damage, and collapse, and the special form covers all risk of direct physical loss unless excluded. The broad form widens coverage a meaningful step without flipping to open peril. Exam questions often offer perils already in the basic form as distractors, or describe unrestricted open peril language that belongs to the special form. Lock in the broad form signature additions: falling objects, weight of ice and snow, water damage, and collapse, and you will place them correctly every time. Question 30. Which of the following is not one of the 4 elements required for a valid insurance contract? Your options are A. Offer and acceptance. B. Consideration. C. Legal purpose. D. A notarized signature. Which would you go with? Lock it in before the reveal. The correct answer is D. A notarized signature. D is correct because a valid contract needs competent parties, legal purpose, offer and acceptance, and consideration. Notarization is not among these elements, so an insurance contract can be fully valid without any notary's seal. A is wrong because mutual offer and acceptance is a core element. One party proposes and the other agrees. Without that meeting of the minds, no enforceable contract forms at all. B is wrong because consideration, the exchange of value between the parties, is required for every valid contract. Removing it would leave only a gift or bare promise that courts will not enforce. C is wrong because a lawful object is essential, since an agreement for an illegal purpose is void. Legal purpose genuinely belongs on the list, which means it cannot be the missing element. Every enforceable insurance contract rests on 4 essential elements. Understanding what those elements are and what they are not is the key to this concept. The 4 elements are offer and acceptance, consideration, competent parties, and legal purpose. When all 4 are present, a binding insurance contract exists. Notarization is not on this list. In practice, the applicant makes the offer by submitting an application with the first premium. The insurer accepts by issuing the policy. The premium and the promise to pay losses supply consideration. The applicant must be a competent adult, and ensuring a lawful interest satisfies legal purpose. Notarization, witnessing, and recording are formal sounding steps, but the law does not require any of them for an insurance contract. Many fully valid policies are formed without a notary ever being involved. When a question mixes the genuine 4 elements with a notarized signature, the notarized signature is always the item that does not belong. Question 31. The premium for a homeowner's home day care endorsement is generally based on which of the following? Your options are A. The number of children cared for. B. The square footage of the home. C. The insured's credit score. D. The age of the dwelling. Don't overthink it. Which one feels right? The correct answer is A. The number of children cared for. A is correct because the home day care endorsement bases its premium on the number of children cared for and converts the liability coverage to an aggregate limit. It also excludes claims of sexual molestation and corporal punishment from coverage. B is wrong because the home's square footage is not the rating basis for the daycare endorsement. The premium reflects the number of children in care, which drives the exposure being insured. C is wrong because a credit score is not used to rate the daycare endorsement, and California restricts credit in many insurance decisions. The endorsement is rated on the number of children cared for. D is wrong because the age of the dwelling does not determine the daycare endorsement premium. The number of children in the operation is the factor the rating is actually built upon. A standard homeowner's policy excludes or sharply limits business activity conducted on the premises. When a parent cares for neighborhood children for pay, that liability can be left entirely uninsured. The home day care endorsement closes that gap without forcing a small provider into a full commercial policy. The endorsement exists because in-home childcare falls into a coverage gap. A plain homeowner's policy limits business pursuits on the premises. So the endorsement adds back a measured slice of liability coverage. Waxie van dat, and prices it in proportion to the actual exposure created. The endorsement sits on top of the base homeowner's policy and adds liability coverage for the daycare activity, which may include medical payments and certain property uses, all within stated limits defined in the endorsement itself. The premium turns specifically on the number of children cared for. More children mean more supervision, more activity, and a greater chance of an injury claim. Each child added increases the exposure, so the rating moves directly with the head count. The key distinction examiners test is what drives the price. The home day care endorsement is rated on the number of children supervised, not floor area, not the home's value, and not a flat charge. When you see in-home daycare premium questions, the answer is the count of children in care. Question 32. Liability insurance is designed to cover an insured's responsibility arising from which of the following? Your options are A. Criminal fines imposed by the state, B. Civil liability for negligent torts, C. Intentional acts meant to harm others, D. Contractual debts the insured owes. Got a guess? Lock it in. The correct answer is B. Civil liability for negligent torts. B is correct because liability insurance covers civil liability for torts, primarily negligence. It does not pay criminal fines, and standard policies exclude intentional acts because coverage exists for the consequences of unintended mistakes. A is wrong because criminal fines are punishment imposed by the state and cannot be shifted to an insurer. Liability coverage responds to civil claims by injured parties, not to penalties in a criminal case. C is wrong because deliberate acts intended to cause harm are typically excluded from liability policies. Insurance addresses accidental, negligent conduct rather than intentional wrongdoing by the insured. D is wrong because a contractual debt is an obligation the insured agreed to pay, not a tort. Liability insurance covers legal responsibility for injury or damage to others, not ordinary business debts. Liability insurance exists to protect people and businesses when carelessness causes harm to others. Understanding what it covers and what it deliberately excludes, it is the core of this concept. A tort is a civil wrong, distinct from both crimes and contract disputes. Negligence. The most common tort means failing to use reasonable care, resulting in injury or property damage to someone else. This is the exact exposure liability insurance is built to cover. For liability to attach, 3 elements must be established. The insured owed a duty of care, that duty was breached, and the breach caused the harm. Once civil liability is proven, the policy responds, paying damages the insured is legally obligated to pay and providing a defense. Liability coverage is intentionally narrow. Negligent accidental harm is insurable. That is, the fortuitous risk insurance spreads. Criminal acts cannot be insured away by law, and intentional injuries are excluded because covering deliberate wrongdoing would invite it and violates public policy. When harm flows from carelessness and the responsibility is civil, liability insurance responds. Crimes and intentional acts fall outside the policy. Anchor coverage to civil, fault-based, unintentional wrongs, and you will always separate the insurable from the uninsurable. Question 33. A jury awards an injured plaintiff money for pain and suffering and emotional distress. These awards are best classified as which type of damages? Your options are A. Special damages, B. Punitive damages, C. General damages, D. Liquidated damages. Which one is it? Pause the video if you need more time. The correct answer is C. General damages. C is correct because general damages compensate for non-economic harm such as pain, suffering, and emotional distress. They are real but cannot be tied to receipts. So a jury assigns a dollar value based on the severity of the harm. A is wrong because special damages cover specific, measurable economic losses like medical bills and lost wages. Pain and suffering has no precise dollar figure, which places it outside the special category. B is wrong because punitive damages punish willful or grossly negligent conduct rather than compensate the plaintiff. Awards for pain and suffering are compensatory, aimed at the plaintiff's loss, not at punishment. D is wrong because liquidated damages are a sum fixed in advance by a contract, not awarded for tort injuries. Pain and suffering is determined by the jury after the harm, not set beforehand. When a court compensates an injured plaintiff, the award breaks into distinct categories. Understanding how those categories work and what belongs in each is the key insight here. Compensatory damages split into two kinds. Special damages cover measurable economic losses, medical bills, lost wages, documented out-of-pocket costs. General damages cover intangible harms like pain, suffering, and emotional distress, which are real but have no invoice. Punitive damages are a separate category entirely, meant to punish bad conduct rather than compensate any loss. The distinction comes down to countability. Special damages can be tallied from receipts and documents. General damages, pain, suffering, emotional distress, are equally real injuries, but no stack of invoices can measure them, so the jury exercises judgment to assign their value. Whenever you see pain and suffering, emotional distress or mental anguish, those signal general damages. Documented economic losses signal special damages, and any language about punishing the defendant points to punitive damages, a wholly separate idea from compensation. Question 34. A fiduciary bond is required of which of the following parties? Your options are: a judicial bond manages assets. B. A fiduciary bond covers civil litigation. C. A public official bond covers contractors. D. A fiduciary bond protects court-managed assets. Take a second. Which answer would you pick? The correct answer is D. A fiduciary bond protects court-managed assets. D is correct because a fiduciary bond is required of a court-appointed person, such as a guardian, executor, or trustee, to protect the assets they manage for others. A judicial bond instead protects parties from losses during civil court proceedings. A is wrong because managing assets for others is the fiduciary bond's purpose, not the judicial bonds. A judicial bond relates to the litigation process itself, not to managing someone's property. B is wrong because covering civil litigation describes a judicial bond, not a fiduciary bond. A fiduciary bond protects the assets handled by a court-appointed guardian, executor, or trustee. C is wrong because contractors are bonded with contract bonds, not public official bonds. A public official bond guarantees that an office holder handles public funds and duties faithfully and honestly. A fiduciary bond is a court bond required whenever a judge appoints someone to manage assets on behalf of another person. Understanding how it works means understanding the three parties involved and what it protects. Courts require a fiduciary bond from three types of appointees: a guardian, managing a minor's inheritance, an executor settling a deceased person's estate, and a trustee holding property for a beneficiary. Each controls assets belonging to someone else. The bond is a three-party arrangement. The principal is the fiduciary who must act honestly. The obligé is the protected party whose assets are at stake, and the surety is the company that issues the bond, paying the loss if the fiduciary breaches their duty, then seeking reimbursement from that fiduciary. It's easy to confuse fiduciary bonds with litigation bonds. Both are judicial bonds. A fiduciary bond covers a court-appointed steward protecting assets managed for others. A litigation bond instead protects parties from losses that arise during the course of civil court proceedings. Whenever you see a court-appointed guardian, executor, or trustee handling someone else's property, that's your signal. The bond protecting those assets is a fiduciary bond. Question 35. An insurer collects premiums from many policy holders, so the premiums of the many can fund the losses of the few. This arrangement is best known as which of the following? Your options are A. Risk pooling or spread of risk, B. Adverse selection, C. Subrogation, D. Reinsurance. Before I reveal it, which one do you think is right? The correct answer is A. Risk pooling or spread of risk. A is correct because risk pooling, also called spread of risk, is the mechanism by which premiums from a large group fund the losses suffered by a small fraction of that group. It is the financial engine that makes insurance work. B is wrong because adverse selection describes higher risk individuals seeking coverage more than lower risk ones. It is a threat to a balanced pool, not the pooling mechanism that funds losses. C is wrong because subrogation lets an insurer recover from a negligent third party after paying its insured. That recovery right operates after a loss and is unrelated to how premiums are gathered and shared. D is wrong because reinsurance is insurance purchased by an insurer to transfer part of its own risk. It shifts risk between companies rather than describing how an insurer spreads risk among policyholders. Insurance is built on one foundational idea: the contributions of many policyholders fund the losses of the few. This mechanism is called risk pooling, or the spread of risk, and it is the principle that makes the entire insurance system possible. No single family can absorb the total loss of a home, but when thousands each contribute a modest premium, the shared pool holds enough to rebuild the few homes that burn each year. The many who suffer no loss effectively fund the few who do. In practice, the insurer assembles a large group of similar exposures, charges each a premium reflecting their risk, and pays covered losses from the accumulated fund. As the number of similar, independent exposures grows, the law of large numbers makes the group's actual loss experience converge on the expected average. For pooling to remain sound, 3 conditions must hold. Exposures must be numerous and similar, losses must be largely independent and accidental, and premiums must be adequate so that contributions coming in match the losses and operating costs going out. Risk pooling is broader than any single risk transfer. When you hear premiums of the many paying losses of the few, that is risk pooling, the group mechanism at the heart of insurance, distinct from reinsurance or a single insured shifting risk to a carrier. Question 36. Business income coverage under a commercial property policy is triggered by which of the following? Your options are A. Any drop in business revenue, B. Direct physical loss by a covered peril, C. A general economic downturn, D. The owner's decision to close. What's your answer? Commit to one before I continue. The correct answer is B. Direct physical loss by a covered peril. B is correct because business income coverage requires direct physical loss or damage to property at the premises by a covered cause of loss. Without that physical trigger, lost income by itself is not covered under the policy. A is wrong because a mere drop in revenue does not trigger the coverage. The policy responds only when direct physical damage by a covered peril forces a suspension of the insured's operations. C is wrong because a general economic downturn involves no physical damage and is not covered. Business income coverage depends on a covered physical loss to property, not on market conditions. D is wrong because a voluntary closure without any physical damage fails to set the coverage in motion. The loss must arise from covered direct physical damage to property at the described premises. Business income coverage is a time element coverage that replaces earnings lost when a business suspends operations. But it doesn't respond to just any financial setback. A very specific trigger must be met before coverage applies. 3 conditions must all be satisfied. There must be direct physical loss or damage to covered property. That damage must be caused by a covered peril, and it must result in a suspension of operations, a revenue drop, lost customer, or market downturn alone, with no physical damage, does not trigger the coverage. Picture a restaurant in Napa whose kitchen is gutted by fire. The fire is a covered peril causing direct physical damage to covered property, forcing a suspension. Business income coverage then steps in, replacing lost net income and paying continuing expenses like rent throughout the period of restoration. A fire destroying the kitchen or a storm damaging the roof both qualify, direct physical loss from a covered peril. But losing a key customer or closing because a nearby attraction shut down involves no physical damage to covered property, so the income coverage never turns on. The physical damage trigger keeps business income coverage anchored to genuine property losses rather than ordinary business risks. No covered physical loss, no income coverage, and that is the line examiner's test. Question 37. How does a commercial blanket fidelity bond differ from a blanket position bond? Your options are: A. Commercial blanket pays per employee. B. Blanket position pays 1 penalty per loss. Says commercial blanket pays 1 penalty per loss. D. They are identical. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. Commercial blanket pays 1 penalty per loss. C is correct because a commercial blanket fidelity bond pays 1 penalty per loss regardless of how many employees were involved, while a blanket position bond pays a penalty per employee involved. Blanket position can therefore provide more coverage in a collusion. A is wrong because commercial blanket pays 1 penalty per loss, not per employee. Paying per employee involved describes the blanket position bond, which can multiply the available recovery in a collusion. B is wrong because blanket position pays per employee involved, not 1 penalty per loss. The single penalty per loss approach belongs to the commercial blanket bond, which caps recovery regardless of how many employees took part. D is wrong because the two are not identical. They differ in how the penalty applies. Commercial blanket is per loss, while blanket position is per employee, which affects total recovery in collusion cases. Fidelity bonds protect employers from losses caused by dishonest employees. Two common blanket forms, the commercial blanket bond and the blanket position bond, cover the same exposure but attach their limits in fundamentally different ways. The commercial blanket bond pays a single penalty for any one loss event, regardless of how many employees were involved. The blanket position bond pays a separate penalty for each dishonest employee, so the total recovery grows with the number of people who colluded. When employees collude, the difference becomes dramatic. Under a commercial blanket bond, a 4-employee scheme still recovers only one limit for the entire event. Under a blanket position bond, that same scheme can recover up to the limit for each of the 4 employees individually. The signal phrase for the commercial blanket form is 1 penalty per loss. The blanket position form multiplies the limit by the number of dishonest employees involved. The distinction matters most when several employees collude. Nefacing meets sayhat. That is precisely where blanket position can reach a far higher recovery. Question 38. Under an open peril or special form, property policy, which party bears the burden of proving whether a loss is covered? Your options are: A. Insured proves a listed peril. B. The state insurance department. C. A neutral appraiser decides. D. Insurer must prove an exclusion. Which would you go with? Lock it in before the reveal. The correct answer is D. Insurer must prove an exclusion. D is correct because open peril coverage insures all direct physical loss except what is specifically excluded, so the insurer must prove an exclusion applies. Under named peril coverage, the insured must show the loss came from a listed peril. A is wrong because requiring the insured to prove a listed peril describes named peril coverage. Open peril flips that burden, presuming coverage unless the insurer points to a specific exclusioner. B is wrong because the state insurance department regulates insurers but does not decide individual coverage burdens. Whether a particular loss is covered turns on the policy and which party must prove an exclusion. C is wrong because an appraiser resolves disagreements over the dollar amount of a loss, not whether a peril is covered. The burden of proof on coverage rests with the insurer under open peril forms. Property policies come in two fundamental forms, and the form used determines who must prove what when a claim is disputed. Understanding this burden of proof distinction is essential to interpreting coverage correctly. Under a named peril form, the insured must prove the loss was caused by a listed peril. Under an open peril form, the logic reverses. The insured only needs to show a direct physical loss, and the insurer must then prove an exclusion to deny the claim. An open peril claim proceeds in two steps. First, the insured demonstrates a fortuitous direct physical loss to covered property. Second, if the insurer wants to deny payment, it must come forward and prove that a specific exclusion, such as wear and tear, flood, or earth movement, actually applies. The open peril structure exists because whoever relies on a clause to win must prove it. Since the insurer relies on exclusions to escape paying, the insurer carries that burden. The insured who cannot be pinned to an exclusion receives coverage by default. Remember, named peril puts the burden on the insured to prove a listed peril caused the loss, while open peril puts the burden on the insurer to prove an exclusion. Whoever relies on a clause must prove it, and under a special form, that party is the insurer. Question 39. Within an insurance company, what is the primary purpose of the underwriting process when an application is submitted? Your options are A. To evaluate and select acceptable risks. B. To adjust and pay submitted claims. C. To market policies to new customers. D. To invest the insurer's reserves. Don't overthink it. Which one feels right? The correct answer is A. To evaluate and select acceptable risks. A is correct because underwriting is the process of evaluating the risk an applicant presents and deciding whether to accept it and on what terms. Sound selection keeps the risk pool balanced and protects the insurer's solvency. B is wrong because adjusting and paying claims is the claims function, which operates after a loss occurs. Underwriting happens earlier, at the point of deciding whether to issue coverage at all. C is wrong because attracting customers is the role of marketing and producers. Underwriting may screen the business those efforts bring in, but its job is risk selection rather than sales. D is wrong because managing the company's investments is a financial function separate from risk selection. Underwriters assess applicants. They do not direct where the insurer's reserves are placed. Underwriting is the gatekeeping function that sits at the very beginning of the insurance process, before any policy is ever issued. Its core purpose is to evaluate and select acceptable risks, protecting the health of the entire insured pool. When an application arrives, the underwriter makes one of three decisions: accept the risk as submitted, decline it outright, or accept it under modified terms such as a higher deductible or specific exclusions. Accepted risks are then classified so that similar exposures are grouped and priced together. Think of the underwriter as a bouncer at the door of the risk pool. Not every applicant gets in, and those who do must belong to the right group, because letting in the wrong crowd would drive up losses for everyone already inside. It is critical not to confuse underwriting with other insurer functions. Claims adjusting happens after a loss occurs. Rate making establishes the pricing structure underwriters apply. Underwriting alone is the upfront evaluation and selection that decides who enters the pool and on what terms. Whenever you see language about evaluating applications, accepting or rejecting risks, or guarding against adverse selection, that is underwriting. Claims handling and marketing come later. Underwriting is always the upfront gatekeeping step. Question 40. Following an accident, a liability policy requires the insured to refrain from doing which of the following? Your options are A. Notifying the insurer of the claim, B. Voluntarily admitting liability or settling, C. Cooperating with the defense, D. Forwarding legal papers to the insurer. Got a guess? Lock it in. The correct answer is B. Voluntarily admitting liability or settling. B is correct because a liability policy requires the insured not to voluntarily assume liability, make a payment, or settle a claim without the insurer's consent. Doing so could undermine the insurer's ability to defend the claim properly. A is wrong because prompt notice to the insurer is a required duty, not prohibited act. The insured must report the claim, so notifying the insurer is exactly what the policy expects after a loss. C is wrong because cooperating with the defense is a duty the policy imposes, not one it forbids. The insured is expected to assist the insurer, which is the opposite of a prohibited action under the policy. D is wrong because the insured must forward all demands, notices, and legal papers to the insurer. Sending those documents is a required duty after a loss, not something the insured should ever avoid doing. After a liability accident, your policy doesn't just tell you what to do, it also tells you what you must not do. This restraint exists because the insurer, not you, will ultimately pay the claim. The insured must give prompt notice, cooperate fully, and forward all legal papers. But the insured must not admit liability, voluntarily settle, or assume any obligations, except at their own expense. Because the insurer bears the financial consequences of a covered claim, it reserves the right to investigate, defend, and negotiate. Any early admission or private payment by the insured can undermine that control. When an accident occurs, the insured reports it and steps back. The insurer then takes control, evaluating the claim and deciding whether and how to settle with the claimant. Remember, the prohibition on voluntary admissions is the duty of restraint. The insured notifies and cooperates, but leaves all liability decisions to the insurer that will pay the claim. Question 41. A burglar steals jewelry from an insured's home. Under an unendorsed homeowner's policy, the special sublimit on jewelry applies specifically to which kind of loss? Your options are A. All covered losses, B. Fire losses only, C. Theft losses only, D. Flood losses only. Which one is it? Pause the video if you need more time. The correct answer is C. Theft losses only. C is correct because the special dollar sublimit on jewelry, watches, and furs applies only to losses by theft. A fire loss to the same jewelry is not capped by that theft sublimit and is covered up to the coverage C limit. A is wrong because the jewelry sublimit is not triggered by every peril. It is specifically a theft limitation, so non-theft losses such as fire are not subject to it. B is wrong because the sublimit does not apply to fire. A fire loss to jewelry is settled under the broader coverage C limit. The cap is tied to theft, not to fire. D is wrong because flood is excluded entirely from the homeowner's policy, so no jewelry sublimit would come into play. The relevant cap concerns theft of the jewelry. Homeowners' policies include a special internal limit on jewelry, but this cap doesn't apply to every covered peril. Understanding exactly when it triggers and when it doesn't is the key distinction here. The special sublimit on jewelry is peril specific. When a burglar steals jewelry, the policy pays only up to that theft sublimit, even if the items are worth far more. But if a fire or windstorm destroys the same jewelry, the theft cap doesn't apply, and coverage falls under the ordinary coverage C limit. Visually, the difference is stark. A theft claim hits the sub-limit ceiling well below the jewelry's true value, leaving a gap in recovery. The exact same pieces lost in a fire reach the full coverage C limit, because the special cap only bites when the cause of loss is theft. Insurers cap jewelry theft specifically because jewelry is small, extremely valuable, and uniquely attractive to thieves. A burglar can pocket thousands of dollars of rings and watches in seconds, a concentrated theft risk that fire or wind simply don't present. Capping theft exposure keeps premiums manageable for everyone. The exam tests whether you recognize that the jewelry sublimit is triggered by theft alone. Fire, windstorm, and other covered perils leave jewelry under the regular coverage C limit. When jewelry is stolen, the special cap controls. When it's lost any other covered way, it does not. Question 42. An insured schedules a diamond ring on the homeowner's scheduled personal property endorsement. Compared with unendorsed coverage, what is one effect of scheduling the ring? Your options are A. It adds a higher deductible. B. It narrows coverage to theft. C. It reduces coverage to actual cash value. D. It removes the coverage C theft sublimit. Take a second. Which answer would you pick? The correct answer is D. It removes the coverage C theft sublimit. D is correct because scheduling the ring removes it from the coverage C theft sublimit and ensures it open peril, typically with no deductible. The scheduled amount replaces the small unscheduled jewelry limit. A is wrong because scheduling generally applies no deductible to the listed item, rather than adding a higher one. The endorsement broadens protection instead of imposing a larger retention. B is wrong because scheduling broadens coverage to open peril, not narrows it to theft alone. The scheduled ring is protected against a wide range of causes, not just theft. C is wrong because scheduling typically provides agreed or replacement type settlement, not a reduction to actual cash value. The endorsement enhances valuation rather than depreciating the item. When a homeowner's policy includes a scheduled personal property endorsement, sometimes called a personal articles floater, it pulls specific items out of standard coverage C and gives each one its own dedicated terms. Understanding what that shift actually does is the key concept here. Unendorsed homeowners' policies impose a special internal theft sublimit on jewelry. Often a few $1,000s, well below the value of most engagement rings or heirloom pieces. The base coverage is also narrow in the perils it covers, leaving valuable items genuinely underprotected. Scheduling physically removes the ring from under that theft sublimit. Instead of sharing a low cap with all other jewelry, the ring carries its own scheduled amount, typically an agreed value set at appraisal, and is covered on a broader open peril basis. Scheduling delivers 4 concrete advantages. The coverage C theft sublimit disappears, the item gets its own full scheduled limit, coverage broadens to an open peril basis that picks up accidental loss and mysterious disappearance, and scheduled items typically carry no deductible. The owner pays an added premium rated on the item's value. The critical takeaway is that scheduling is not cosmetic. It pulls the item out from under the narrow theft cap entirely and replaces that cap with the item's own agreed value on broader terms, trading a token recovery for real protection. Question 43. Which homeowner's form is designed for a tenant and provides no coverage A for the dwelling itself? Your options are HO4, B H3, C AO6, DIY. Before I reveal it, which one do you think is right? The correct answer is A, HO4. A is correct because the HO4 is the tenant's or renter's form. It covers the tenant's personal property and personal liability, but provides no dwelling coverage, since the tenant does not own the building. B is wrong because the HO3 is an owner-occupant form that insures the dwelling open peril. A renter who does not own the structure would not buy dwelling coverage under an HO3. C is wrong because the HO6 is the unit owner's form for condominium owners, providing limited building coverage for interior elements. It is not the renter's form, and it does include some coverage A. D is wrong because the HO8 is the modified form for owner-occupants of older homes, settling losses at actual cash value. It covers the dwelling and is not intended for tenants. When a tenant rents rather than owns a home, a standard homeowners policy isn't the right fit. The homeowners program includes a specialized form designed exactly for renters, the HO4, also called the renter's form. The HO4 focuses on what a tenant actually needs. It provides coverage C for personal property on a broad named peril basis, personal liability, medical payments to others, and loss of use coverage if a covered loss makes the unit uninhabitable. The defining feature of HO4 is what it deliberately leaves out, coverage A for the dwelling structure. The tenant doesn't own the building. The landlord does, so there is no need and no charge for structural coverage. The key distinction is ownership. The landlord owns and insures the structure. The tenant is responsible only for personal belongings and liability from their own activities. HO4 prices coverage around those real exposures, making it affordable and appropriate. When you see tenant or renter on the exam, the answer is HO4. It covers personal property and liability, but carries no coverage A, because the structure belongs to the landlord, not the renter. Question 44. The special causes of loss form provides the broadest commercial property coverage by insuring against which of the following? Your options are only listed perils. B, all direct loss except exclusions. C, flood and earthquake. D, wear and tear. What's your answer? Commit to one before I continue. The correct answer is B, all direct loss except exclusions. B is correct because the special form covers all direct physical loss unless the cause is specifically excluded, making it the broadest causes of loss form. The insurer must point to an exclusion in order to deny a claim. A is wrong because covering only listed perils describes the basic and broad named peril forms. The special form takes the opposite approach, covering everything except the causes it specifically excludes. C is wrong because flood and earthquake remain excluded even under the broad special form. They require separate coverage rather than being insured automatically by the open peril approach. D is wrong because wear and tear is the standard exclusion in the special form. Gradual deterioration is not a fortuitous loss, so even the open peril form does not extend coverage to it. Commercial property policies come in three forms, and understanding what separates them is essential for any exam candidate. The special form stands apart because of how it defines coverage, not by listing what's covered, but by listing what's not. The basic and broad forms are named peril forms. They cover only the perils explicitly listed in the policy. The special form flips this logic entirely, covering all direct physical loss unless a specific exclusion applies. Think of the special form as a vast open territory where coverage is the default. The exclusions, flood, earth movement, wear and tear, carve out a defined boundary, but everything outside that boundary is automatically covered. No peril needs to be named for coverage to apply. Named peril forms inevitably leave gaps because no list can foresee every way property can be damaged. Under the special form, an unusual or hard to classify loss is covered by default, and if the insurer wants to deny a claim, they must point to a specific applicable exclusion. Remember the distinction. Basic and broad forms cover only what they name, while the special form covers all direct physical loss except what it excludes. Breadth by subtraction, covered unless excluded, is the defining feature of the special form. Question 45. A combined single limit on a liability policy provides coverage in which of the following ways? Your options are A. Separate caps for each injured person. B. No limit at all. C. One total limit for all losses. D. A limit only for property damage. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. One total limit for all losses. C is correct because A combined single limit provides one total amount that applies to all bodily injury and property damage from a single occurrence. This gives flexibility since no separate per person or per category cap divides the coverage. A is wrong because separate per person caps describe split limits, not a combined single limit. The combined single limit deliberately avoids dividing the coverage among individual claimants or categories of loss. B is wrong because a combined single limit is still a limit simply expressed as one figure. It caps the total payment for an occurrence rather than providing unlimited coverage to the insured. D is wrong because a combined single limit covers both bodily injury and property damage together. Limiting it to property damage alone would ignore the bodily injury it is specifically designed to include. A combined single limit is one total amount of liability coverage available for all losses from a single occurrence. Understanding how it differs from split limits is the core concept here. The combined single limit pulls all coverage into one total. There are no internal walls separating bodily injury from property damage. The entire limit responds to the whole loss in whatever proportion the accident produces. Visually, a combined single limit is one bucket. Split limits are three separate containers: a per-person bodily injury cap, a per-accident bodily injury cap, and a separate property damage cap. An unused capacity in one container cannot flow to another. Split limits divide coverage into three distinct maximums. In a serious accident where one person's injuries exceed the per-person cap, that claimant cannot draw from the unused property damage limit. Those internal walls hold firm regardless of the total loss. The combined single limit removes all internal divisions, letting every dollar stand behind whatever combination of injury and damage an occurrence actually produces. One pool, total flexibility, set equal, that is what sets it apart from split limits. Question 46. Under California law, when the governor declares a state of emergency, residential property insurers must offer policyholders in the affected area a premium grace period of which length? Your options are A. 10 days, B. 30 days, C. 45 days, D. 60 days. Which would you go with? Lock it in before the reveal. The correct answer is D. 60 days. D is correct because California Insurance Code Section 23062 requires insurers to offer a 60-day grace period for premium payment on residential property policies in an area covered by a declared state of emergency. A is wrong because 10 days falls far short of the statutory relief the law provides after an emergency. Section 20 U.S.C. 2 sets the residential property grace period at 60 days, not 10. B is wrong because 30 days, while common for other notices, is not the figure used here. The emergency grace period for residential property premiums is twice that length under Section 26 NU2. C is wrong because 45 days is not the period specified for emergency premium relief. The statute fixes a 60-day window, so a shorter span understates the protection owed to affected policyholders. California law gives residential property policyholders special protection when disaster strikes. Under Insurance Code Section 2062, a governor's declaration of a state of emergency triggers an extended grace period for premium payment, keeping coverage alive exactly when policyholders need it most. 3 elements define this rule. First, the trigger must be a governor's official declaration of a state of emergency. Second, it applies only to residential property policyholders in the affected area. Third, the insurer must allow a full 60 days to pay any premium that comes due, far longer than the ordinary grace period. Think of it as a pause button. A family evacuated by wildfire may lose access to mail, records, and income for weeks. The 60-day window gives displaced residents time to regroup and pay without forfeiting the coverage they need most to rebuild. In practice, the moment a gubernatorial declaration covers an area, affected policyholders automatically receive 60 days from the premium due date before the insurer can cancel for non-payment, replacing the much shorter ordinary grace period for the duration of the emergency. Remember the 2 facts examiners test, the 60-day length and the governor's emergency declaration as the trigger. Any answer offering a different time frame or a different trigger is the wrong rule. Question 4. Coverage B of the commercial general liability policy, personal and advertising injury, responds to which of the following? Your options are A. Libel, slander, and false arrest. B. Fire damage to the building. C. Employee medical bills. D. Auto collision damage. Don't overthink it. Which one feels right? The correct answer is A. Libel, slander, and false arrest. A is correct because coverage B, personal and advertising injury, responds to listed offences such as libel, slander, false arrest, wrongful eviction, and invasion of privacy. Unlike coverage A, it does not require an occurrence to trigger coverage. B is wrong because fire damage to a building is a first-party property loss, not a personal and advertising injury offence. Coverage B addresses reputational and similar wrongs, not physical damage to property. C is wrong because employee medical bills relate to workers' compensation, not personal and advertising injury. Coverage B covers offences like libel and slander, not the treatment of an injured employee. D is wrong because auto collision damage is covered under a commercial auto policy, not coverage B. Personal and advertising injury concerns non-physical offences, not damage to vehicles in a crash. Coverage B of the commercial general liability policy exists to fill a gap that physical harm coverage leaves open. It responds to a defined list of offences that injure a person's reputation, liberty, or privacy, not their body. The covered offences are a defined list, dignitary and reputational wrongs. These include libel, slander, false arrest, wrongful eviction, malicious prosecution, invasion of privacy, and misuse of another's advertising idea or slogan. Coverage A and coverage B sit side by side within the same policy but reach entirely different wrongs. Coverage A answers for bodily injury and property damage. Coverage B answers when the harm is to a name, a liberty, or a privacy interest. In operation, coverage B responds when the insured commits one of the enumerated offences and is legally liable. The policy then pays damages and provides a defence, subject to its own limit and exclusions. The key question is always whether the wrong fits a listed category. When analysing a claim, ask what kind of harm occurred. Language about defamation, false arrest, or invasion of privacy points to coverage B. Language about bodily injury or property damage points to coverage A. Route the wrong to the right insuring agreement. Question 48. The Federal Longshore and Harbour Workers' Compensation Act provides benefits to which group? Your options are A. Railroad workers, B. Maritime and harbour workers, C. Office workers, D. Overseas soldiers. Got a guess? Lock it in. The correct answer is B. Maritime and harbour workers. B is correct because the Longshore and Harbour Workers' Compensation Act provides federal workers' compensation benefits to maritime workers such as longshore and harbour workers on navigable waters and adjacent areas. It is added through the longshore endorsement. A is wrong because railroad workers are covered under the Federal Employers Liability Act, not the Longshore Act. The Longshore Act applies to maritime and harbour workers, a different group of employees. C is wrong because ordinary office workers are covered by state workers' compensation, not this federal maritime statute. The Act specifically covers longshore and harbour employment on navigable waters. D is wrong because overseas contractors and similar workers fall under the Defence Base Act, not the Longshore Act directly. The Longshore Act covers domestic maritime and harbour workers. The Longshore and Harbour Workers' Compensation Act is a federal law filling a critical gap in workplace injury coverage for maritime workers. It exists because state compensation laws couldn't reach injuries on navigable waters, and vessel crew members were already covered separately, leaving dockside workers unprotected. Coverage depends entirely on where you work and what you do. Land-based employees fall under state workers' compensation. A vessel's master or crew falls under the separate seaman's remedy. Maritime and harbour workers on and beside navigable waters fall under this federal act. Longshoremen, ship repairers, shipbuilders, and harbour workers on piers, docks, and terminals adjacent to navigable waters are the core covered group. The Act provides medical benefits, disability payments, and survivor benefits funded through their maritime employers. The key exam skill is separating the covered group from the traps. Longshoremen, ship repairers, shipbuilders, and harbour workers are covered. Office workers and factory workers remain under state systems, and a vessel's crew looks to the seaman's remedy. Neither falls under this federal act. When you see signal words like longshore, harbour worker, navigable waters, or loading and unloading vessels, the federal act applies. Ordinary land workers means state compensation, and vessel crew means the seaman's remedy. Question 49. Which of the following correctly describes supplementary bail bond payments under the Commercial General Liability Policy? Your options are A. The CGL covers the insured's property. B. Defense reduces the limit. C. CGL bail bonds are a small amount. D. There are no supplementary payments. Which one is it? Pause the video if you need more time. The correct answer is C. CGL bail bonds are a small amount. C is correct because under the CGL, supplementary payments include bail bonds up to a small stated amount, $250, paid in addition to the limit. The business auto policy provides a higher bail bond amount of $2,000. A is wrong because the general liability policy covers the insured's liability to others, not the insured's own property. Supplementary payments like bail bonds support the defense. They do not insure property. B is wrong because supplementary payments, including bail bonds, are paid in addition to the limit and do not reduce it. The full limit remains available for damages alongside these supplementary amounts. D is wrong because the policy does provide supplementary payments, including bail bonds and loss of earnings. Saying there are none ignores the additional payments the policy makes beyond the limit. Supplementary payments are extras the insurer pays on top of the policy's limit of insurance. They never reduce the money available to pay a claimant. Understanding what belongs in this category and at what dollar amounts is a classic exam topic. The supplementary payments list covers all defense costs, bond premiums, post-judgment interest, and the insured's lost earnings when attending trial at the insurer's request. Bail bond reimbursement is one small line in that list. Under the standard commercial general liability policy, bail bond reimbursement is capped at $250. The business auto policy provides a much larger cap of $2,000, reflecting its closer connection to vehicle-related incidents. Think of the liability limit as the main rope. It exists entirely to catch damages owed to an injured party. Supplementary payments are a separate net underneath, catching defense costs and bond reimbursement so the full limit remains untouched. The trappers think in the bail bond reimbursement reduces the limit. It never does. Remember, $250 for general liability, $2,000 for business auto, and both are paid in addition to, not out of, the policy limit. Question 50. On a personal yacht policy, the liability coverage that protects against third-party injury and property damage is known as which of the following? Your options are A. Hull coverage, B. Collision coverage, C. Cargo coverage, D. Protection and indemnity. Take a second. Which answer would you pick? The correct answer is D. Protection and indemnity. D is correct because protection and indemnity is the liability portion of a yacht policy, covering third-party bodily injury and property damage. It is the marine equivalent of general liability, distinct from the hull coverage on the vessel itself. Others wrong because hull coverage ensures physical damage to the vessel itself, not liability to others. The third-party liability portion of a yacht policy is provided through protection and indemnity instead. B is wrong because collision coverage is an auto physical damage term, not the yacht liability coverage. Marine third-party liability on a yacht falls under protection and indemnity, not collision. C is wrong because cargo coverage protects goods in transit, not a yacht owner's liability to others. The liability component of a personal yacht policy is called protection and indemnity. In ocean marine insurance, a yacht policy splits into two distinct coverages, one for the boat itself and one for the harm the boat causes to others. Understanding why that split exists is the key to this concept. Every yacht policy carries two separate coverages answering to two separate exposures. Hull coverage responds to physical damage to the insured vessel itself, the owner's own property. Protection and indemnity, often called PE, responds to the owner's legal liability for bodily injury and property damage caused to others. Picture a yacht striking another vessel and injuring a passenger aboard it. The damage to the other boat and the injured person's bodily injury claim both fall under protection and indemnity, the marine equivalent of general liability coverage. Any damage to the owner's own yacht, such as hitting a submerged object, falls under hull coverage instead. Hull and P&I each do one job and one job only. Hull pays for direct physical damage to the insured yacht. P&I pays third-party bodily injury and property damage claims and funds the legal defense of the owner, mirroring the separation of property and liability coverage on land. When a yacht policy question turns on third-party liability on the water, the answer is protection and indemnity, the marine cousin of general liability. Remember, hull for harm to the boat, protection and indemnity for harm the boat causes to others.
You have reached the end of our first question set. For the free complete exam preparation, visit our website, link in the description, where you find thousands more practice questions and comprehensive study guides. Thanks for studying with us today. See you in the next video.